Hello and welcome to How to Invest. In today's video, we're going to talk about HIMS and HERS stock. First, a little bit about me. I work for a holding company that has over $7 million under management, as well as a personal $100,000 portfolio. I work as a stock analyst. So today we're talking about HIMS and HERS Health. If you don't know what this company is, we're just going to go over really quickly. They run a online pharmacy, as well as having their own manufacturing for a lot of the medicines they provide. They do compounding, which basically just means that these medications are customized, and these customized medications are far more effective for patients. On top of that, they are collecting tons and tons of data, and they are hoping to lead the industry with AI doctors. A lot of their physicians are already being supercharged by AI assistants, helping them in their decision making and all that kind of stuff. So I am super bullish on this company. It is my second largest holding personally. The holding company does not currently own any shares of HIMS or HERS, but I am really bullish on this company, and I think there is definitely some plans in the cards to add some shares to the holding company in the future. We're just super bullish on Lemonade right now, so we are very heavily invested in Lemonade. So more about HIMS, just going over the bear case a little bit. They do face some legal issues. So the maker and patent holder of GLP-1s is Novo Nordisk. They have recently made some claims about HIMS and HER Health, though they have not actually officially filed a lawsuit against HIMS and HERS at the moment of this recording. Another potentially bear case argument for HIMS and HERS Health is that they do not win the AI doctor race. Some reason they are not able to develop it effectively. The data they hold is not as good as they think it is, and that their current vertical growth start to stall out, and they're not able to successfully deploy new health verticals. For many reasons, I don't think that will be what happens whatsoever. Over on the bull case, we think that there is the possibility that the HIMS and HER platform is able to completely disrupt traditional health with the fact that you can do online doctor's appointments, so you don't have to pay for the brick and mortar. So just the cost of healthcare goes down drastically by doing it online and through AI. That traditional health companies can no longer compete against this incredibly cost-effective offering. The fact that their compounded medication is much more effective. The traditional pharmacies can no longer compete. So you see HIMS and HER take a massive share of the health industry. They continue to deploy in new health verticals successfully. They're able to develop the best AI doctor in the world with their proprietary data. So that's kind of the bull case. We think the bull case scenario is much more likely. For sure I do, and that is why it is my personal second largest holding in my portfolio. So let us go over the latest earnings report. So in the latest quarter, they grew revenue 73% year over year, which is a slowdown in revenue growth. This is because they are no longer able to sell GLP-1s, generic GLP-1s, or even the Novo Nordisk's GLP-1s. They are only able to sell compounded GLP-1s. So there's been a bit of the slowdown in their weight loss vertical. So there's a bit of a deceleration in revenue growth. They are not losing revenue. They're still growing revenue at a very healthy rate. So 73% is nothing to complain about whatsoever. But that has been reflected in the stock price a little bit. A lot of people are still convinced this is a GLP-1 company. It is not a GLP-1 company. That is one of many products this company offers. And they are still an incredibly fast grower, even without the GLP-1 story. And the GLP-1 story is not over, in my opinion, either. Novo Nordisk let their patent lapse in Canada, so the HIMS and HER quickly acted upon that and is expanding to the Canadian market to offer generic GLP-1s at a much more competitive price than any other GLP-1 offering in the country. So this company is still very, very situated to take advantage of the GLP-1 and many, many future developments in healthcare. So still growing at a very, very healthy rate. They are profitable with around a 10% net profit margin. The bigger announcements to me was not the revenue or the income statement or the balance sheet for this quarter. It was this guidance they gave. So this is a picture from the earnings call of their roadmap. So as you can see, they currently offer weight loss in the United States and Europe. They offer sexual health in the United States and Europe. They offer dermatology in the United States and Europe. They offer mental health in the United States. They offer hormone health in Europe. And they are coming to market with weight loss in Canada, hormone health in the United States. And this is the big one for me. They are bringing longevity medicine to the United States market. I think this is potentially a massive, massive vertical that has, tailwind effects for all the other verticals as well. So think of it this way. If you are a customer of a company that is keeping you alive for longer, so this is not when you get sick, this is when you're healthy. So this opens up a whole new, vertical for the entire health market. Currently, the health industry is a reactive industry. Now, and so you can only treat sick people. Now it can become a proactive industry, and now everyone can become your customer, not only the percentage of the population that is currently sick or has some kind of issue. So now you are helping keep everyone on the planet alive for longer, and now you do get sick. Who are you going to go to? Some random company that you've never dealt with before, or the company that is literally keeping you alive for longer? There's the amount of customer goodwill that they are going to build with their customer base through this longevity vertical, not to mention the TAM, the total addressable market for longevity, which is just literally everyone on earth. This is a massive, massive, new vertical for Hims and Her Health. I think that this is far bigger story than the GLP-1 story. It is just absolutely crazy how big this, vertical can become. As soon as this offering becomes available, I am planning on starting to I'm already a customer for the dermatology part of Hims and Her Health. I will also subscribe to the longevity because I hope to live for a very, very long time, 120, 200 years, maybe even longer than that. And, if they're helping keep you talk about lifetime value as well. If you're helping keep your customer alive for longer, that means they're going to be your customer for longer. So you could have customers that have been with Hims and Hers Health eventually for 150 years taking this longevity medication. Plus, every time they get sick or have some other kind of issue, they come to Hims and Her Health and they use one of the other health verticals because they just have so much trust and goodwill towards Hims and Hers Health. So I think that this longevity appearing on the roadmap is just absolutely so bullish for Hims and Hers Health stock. I am super excited for it myself, not to mention, the hormone health coming to the United States as well, and the GLP coming to Canada. These are huge growth potential areas for Hims and Hers. So this was the number one thing I was excited about on the earnings call, not the 73% year-over-year growth rate in revenue, which is still absolutely crazy and incredible. The second thing that I was very, very happy to see, again, over the revenue growth, was this. Hims and Hers hires Mo, I have no idea how to pronounce his last name. We'll just call him Mo. They hired Mo to become the AI expert. So this is going to be the start. Potentially, I don't know how much they've already done internally. They are building AI doctors, and they are going to make their AI assistants to their doctors even better in the short term. This makes their physicians and doctors so much more effective. They're able to treat so many more patients using this AI. So, the amount of physicians that Hims and Hers has to have on the team in order to treat all their patients will continue to, maybe it will continue to increase, but not as fast as traditional health insurance companies or traditional hospitals. They have to hire, a doctor can only serve so many patients. Well, the doctors working for Hims and Hers Health are going to be able to serve 10, 100 times more patients because they are super powered by AI. And eventually, once the regulation is in place for it, you'll be able to not even interact with a person. You will be able to have an AI doctor assess you and prescribe medication to you. And now you're talking about the cost per doctor visit basically going to zero, basically just the cost of compute. And there's no way traditional health insurance is going to be able to compete with that, with their brick and mortar hospitals. Obviously, they also have to exist for surgeries and things like that. But the majority of time, people are interacting with the traditional health industry. It's them going to go there, get their yearly checkup. It's them to ask for some kind of prescription medication, which doesn't require any kind of invasive surgery. It can definitely be done online. And so if HIMS and HERS is really able to capitalize on that opportunity, this is, again, just a absolutely massive growth engine potential for this company. So those were the main takeaways from this earnings call. So number one, the longevity vertical. Number two, them hiring Mo here as an AI expert to build out their AI capabilities at HIMS and HERS Health using their incredible proprietary data from their millions of customers. And AI data is so important to creating incredible models. So I'm super excited about that, secondly. And thirdly, the 73% year-over-year revenue growth, which I think that being the third most exciting thing is just crazy to think about. Any company growing at 73% revenue growth whilst being immensely profitable should really pique your interest. And it definitely does for me. It continues to make me very bullish on this company. They have been able to execute at a very high level. So, all right, now that we have covered the company in general, the latest earnings calls, what do we think that means for the future returns of this stock? So let us go to our modeling. We'll look at our modeling and then we will check out some evaluation metrics. So for HIMS and HERS, even though this last quarter was 75% year-over-year growth, we expect the next year for them to grow about 35%, which I think it can definitely be conservative. Past that, HIMS and HERS are guiding that they'll grow around 22%, I think 22% revenue growth. We are estimating that they're going to grow at actually 30%, 25%, 25%, 25% revenue growth over the next 5 years, as you can kind of see on our modeling here. We don't think that's ridiculous. They have been able to continually deploy more and more verticals very successfully. So I think they are sandbagging hardcore on the revenue guidance. And then 20% revenue growth in year 6, 19%, 18%, 17%, down to 16% revenue growth in year 10. And then that continues to taper down to 10% in year 16 year-over-year revenue growth, and that's kind of their terminal growth rate we have for their revenue in our model. Again, this can be super conservative. You could see a re-acceleration in revenue growth with any deployment of any successful vertical. Perhaps a new medication comes onto the market like GLP-1s did, and they are allowed to be sold generic because there's some kind of shortage. Or, you have another case where Novo Nordisk lets their patent lapse, and you have another instance where like Novo Nordisk has their patent lapse, and you just have this insanely massive increase, a new trajectory of revenue growth for HIMS and HERS, and that can happen at any moment. So I think this is a very conservative base case estimate for revenue growth for HIMS over the next 20 years. Now, they are currently at a 10% net profit. We could see that getting to 11% in the next year. Their gross margins are very strong. So we think long-term net profit margin of 25% is very possible and may potentially be conservative, especially as you have the AI doctor offering come in. The net margins on the AI doctor could be incredibly high, as much as 80-90% net margin on an AI doctor visit, because the cost is so low, it's just the cost of compute. So potentially that becoming a large mix of their sales, a large percentage of their sales of these AI doctor visits, you could see net profit margin being even higher. And even now on their medication, they have 76% gross margins. So I think that 25% could technically be conservative on their long-term net margins. I would hope to not see high net margins for a long time, though. I would love to see them to continue to reinvest their free cash flow into growth spend, which would also potentially be another tailwind, even making those revenue numbers, growth numbers, even higher than what we have here in the model. So again, all around, I think this is a pretty conservative base case, very, very possible. We see the PE currently, I think this might be a little bit of an outdated PE, but in 1 year, 60 PE, 5 year, a 40 PE, 10 year, 30 PE, and then kind of a terminal 20 year PE of 25. Now, there is a little bit of dilution happening. So your share will be diluted slightly over the 1 year and the 5 year. And hopefully, they do have some share buybacks in place, but I don't think that's currently overcoming all of the share dilution that is currently happening. So, but in 20 years, we do think that through share buybacks, your share will be a higher percentage ownership of the company than it is now. This is very, very likely, as they just are going to be putting off so much free cash flow. There's no way they don't put more share buybacks in place. They currently have a share buyback in place. So, one more thing I did want to talk about in terms of recent news. This is a big thing a lot of people are scared about. Recently, the CEO, Andrew Durham, did sell $33 million of shares. Now, I want to talk about this because personally, I view this as a huge nothing burger. This does not affect the underlying thesis whatsoever. Let's look at some of the information here in this MarketWatch article. So he sold 660,000 shares out of an average price of $50.58. So this was after the peak of $70, and then after earnings it crashed, and he sold a little bit after that. So personally, I think there's a good chance he was planning on selling after earnings anyways, because if he thought earnings were going to be bad and the stock price was going to, top out, why wouldn't he have sold before earnings? So I think he thought that the stock price was actually going to jump after earnings because they reported an incredible quarter, and he was planning on doing the sale regardless. Unfortunately, that is not how the market reacted. And this is such a small percentage of the shares he owns. So he sold 660,000 shares. He currently owns 8.4 million shares. And on top of that, he has another 6 million shares of stock options available to him. So his total share ownership is actually going to be increasing. He is increasing the amount of shares he owns of HIMS, even though he did this sale. And if we look at further in this article, the reason they are citing that he made this sale was, which was not even out of his personal holdings. I think it was through a trust or something like that. You can go ahead and find this MarketWatch article if you want to read into it a bit more. But here it says, he sold for tax and philanthropic purposes. He is not selling because he does not believe in the company, because he thinks the stock is at an all-time high and it's going to peak and go sideways for the next couple of years. Honestly, I think he sold and was going to sell regardless of what happened after earnings. I think he needed to sell for his own personal reasons that had nothing to do with the company, with the future stock returns. I think people are looking into this way too much. Again, I think this is a huge nothing burger. This is not indicative that the management thinks that the stock share price should be lower and it's going to go sideways for the next couple of years. No. Andrew had his own personal reasons. He needed to cash out a little bit. Totally understandable. He's seen a massive appreciation. He has to be able to live somehow. You can't spend shares at the grocery store. So he is just liquidating a tiny fraction of all the shares he owns. Again, he owns 8.4 million and he has another 6 million in share compensation coming soon. And he sold 660,000. So very, very small, less than 10% of the total shares that he has available to him. And this article is citing that he literally had tax obligations. So it's like so stupid that this is getting such a huge news cycle for the shareholders of this company. It literally means nothing to me. And it should, in my opinion, probably mean nothing to you as well. So now let's look at how these returns look on our charts. So in the 1 year, I actually think there is a decent amount of upside in the stock, especially after this pullback. I think we could see at least we're saying the fair value of HIMS is going to be 60% greater than the current stock price. So we could see definitely some good 1-year returns. The 5-year, this is our base case, 3.4x. A 10-year, 9.1x, so almost a 10x in 10 years, and then a 32x in 20 years on our base case based off those revenue numbers and profit margins we went over. So let's just go look at the numbers we have here for this bull case. 50% revenue growth over the next year, 40%, 35%, 32%, 30% in 5 years. And then that continues to scale down to 20% in 10 years. And then finally 16% kind of terminal growth rate through 20 years. And I think this is not that ridiculous. Again, if some of these verticals that they start to deploy in, have insane demand, and as new medicine is developed, HIMS is perfectly posed to bring those medications to the masses and capitalize on that. So instead of getting to 25% net margin, we could see HIMS getting to a 30% net margin. Again, that is not that crazy with 67% gross margins. So let me double check that. So yeah, it's not 67, 76% gross margins. So incredible gross margins. It's slightly lower. This is from Q1 here. So yeah, 30% net margins. And then we could see a much higher PE of 35 in the 20-year instead of 25. So base case 25 PE, bull case 35 PE in the 20-year. We could see slightly less dilution and even more share buybacks over 20 years. So that increases the amount of ownership per share. Now let's go over to the bull case. In the bull case, HIMS could double in the next year. So 2.5x in the 1 year, a 6x in the 5-year, a 25x in 10 years, and a 173x over the next 20 years. All right, let's go over the final thing I want to cover today, which is some of the evaluation metrics. So enterprise value to earnings is 53. That is not that crazy when this company is growing at 70% year over year. So again, Peter Lynch, he says if the PE ratio number is less than the revenue growth rate, is a good buy. So right now the growth rate is 70% and the PE is 50. So by Peter Lynch's little kind of back of the napkin math, this is still a fair price for the company, and especially at this pullback, I think it is a great time to add shares to your position. Now looking at the enterprise value to look through earnings. So this is taking their 20-year net margin and putting that on their current revenue, what basically their P/E ratio is. It is a 30. So that looks even better when they are growing revenues at 70%, 50 to 70%. It is incredible. It's a very good price. Enterprise value to sales, 4.9, which is pretty cheap compared to some of the other stocks on our list that we still love as well. So cheaper in terms of EV to sales than Lemonade. So many of these companies are at such attractive valuations. I know a lot of people are scared about the market being at all-time highs at the moment. It's really important to note that even though the market could be at all-time highs, there are many, many companies that have low valuations. So, and the total market is very, very heavily weighted these, the Mag 7. So there are so many good deals out there. There are so many stocks at attractive prices to be adding to at this moment, and I think HIMS is definitely one of them. Looking at EV/RG, which is a different variation of the PEG ratio. So that's basically what you're paying for the next year revenues growth. HIMS is at a very, very attractive price of a 0.14, very cheap, cheaper than NVIDIA, cheaper than AMD, cheaper than SoFi, which is a lot of these are retail favorites. Retailers love, traders love these stocks. HIMS is trading at a much lower multiple or a much lower cost for revenue growth in these companies. This is beat the denominator's version of the PEG ratio, which is enterprise value to gross profit to revenue growth. HIMS again trading at a very attractive 0.18, which is very cheap, cheaper than AMD, again cheaper than NVIDIA. So cheaper than SoFi as well. So you can kind of look at what companies we're comparing it to there as well. So, and the last thing, HIMS has 32% of the float shorted. So if we do see a massive run in the price of the stock, there could be quite a large short squeeze, which is always fun to watch. Not important to the thesis, but could bolster short-term returns if we post a really good quarter and excitement comes back to the stock. A lot of people are not very excited about HIMS at the moment just because of the decelerating revenue growth. I don't think that should turn you off to this stock. This stock has incredible long-term returns and has the ability to disrupt one of the largest industries on the planet, which is healthcare. So I am still very bullish on HIMS. I hope you appreciated this kind of rundown overview of the recent news and the quarter shareholder letter. And looking at our modeling, kind of see what we're thinking about it. So this is not financial advice. This is just educational. I hope you were entertained. Thank you. Leave a like and subscribe if you want more of this type of content. Have a great day.